Tobias Adrian is the financial counselor and director of the IMF's Monetary and Capital Markets Department. He leads the IMF's work on financial sector surveillance and capacity building, monetary and macroprudential policies, financial regulation, debt management, and capital markets. Prior to joining the IMF, he was a senior vice president of the Federal Reserve Bank of New York and the associate director of the Research and Statistics Group. Tobias has taught at Princeton University and New York University, and he has published widely in economics and finance journals, including the American Economic Review, the Journal of Finance, the Journal of Financial Economics. He has over 60 publications in top field journals and about 20,000 citations. His research focuses on the aggregate consequences of capital markets developments. He holds a PhD from the Massachusetts Institute of Technology, an MSc from the London School of Economics, a diploma from Goethe University Frankfurt, and a maîtrise from Dauphine University Paris. He is a senior fellow of the RCA. And today's lecture is macrofinancial feedback, bank stress testing, and capital surcharges. Tobias, the floor is all yours. Thank you.
Thank you so much, Claudio, for the kind words, and thanks for having me here at these meetings. I'm very happy to talk to you. So what I'm going to present is new work on macro-financial feedbacks, and I'm very happy to share the paper as well. It's still work in progress. It hasn't been published as a working paper yet, but I'm happy to share it with you all. So I'm sharing my screen now, so you should be able to see the first slide. So this is joint work with Jose Barrospide, who is at the Federal Reserve Board, and Romain Laforguette, who is at the IMF together with me. So the paper is on macro-financial feedback. So it's really macrofinance, bank stress testing, and capital surcharges. So in particular, we are developing a framework to assess the vulnerabilities across the business and financial cycle. So there's a very well-defined notion of a business cycle and a well-defined notion of a financial cycle, but the financial cycle is very different from the literature, and we're going to talk about the differences. And we're calibrating a countercyclical capital buffer. So, in this crisis, in this pandemic, the release of the capital buffer by some authorities, such as the Bank of England, was viewed to be very important in terms of responding effectively to the crisis, because the release of the capital, the countercyclical capital buffer, which is called CCYB, is typically viewed as usable capital. So this can be used to make lending, while other capital is oftentimes viewed by the banks and not being usable. So the CCYB is a very powerful top policy instrument. And so what we're doing is to use a very parsimonious model to quantify the causal impact. And here I'm emphasizing causal. So we do have a causal identification strategy that is a combination of a kind of typical triangular identification, but also instrumental variables. So we are going to construct instrumental variables in order to get exogenous variation to the banking sector. And then we want to isolate the macro financial feedback. So to what extent is the leverage cycle of the banks basically amplifying macro shocks, okay? And then, of course, to the extent that there is this macro-financial feedback, then we argue that the CCYB, the countercyclical capital buffer, should be set so as to mitigate this macro-financial feedback effect. So this is really the philosophy that was used in developing the CCYB, but to my knowledge, a satisfactory sort of like empirical approach hasn't been put forward. There is an empirical approach that is used by many countries, but it's not very satisfactory. And I'm going to talk about that later. So that's really based on credit to GDP gaps. And those are very different from the financial cycle that we are looking at. In particular, the paper is closely linked to my earlier work on growth at risk or vulnerable growth. And in particular, we are going to look at the macro financial feedback effect conditioning on downside risk, so in the downsides. So it's going to, I talk a lot about like where you're in the distribution. Are you in the center of the distribution or in the downside of the distribution? So I will talk briefly about related literature, then the data and empirical model, and then the results and policy implications. So in terms of relevant literature, there's all the work on growth at risk and vulnerable growth that basically links financial conditions to downside risk to aggregate growth. So the literature is showing that when financial conditions tighten, downside risk to growth is increasing a lot, and that is generating an unconditionally very skewed distribution. So GDP growth is a highly left-skewed distribution, and the mechanism is one of financial conditions tightening. Secondly, the paper relates to aggregate stress testing. As you know, every supervisory agency, every central bank is now using stress tests for the banks, but these are primarily microprudential. So we try to make them truly macroprudential. And there's also literature that is looking at the effectiveness of stress testing. So here is our basic approach. So we are looking at GDP as the macro variable. So it's going to be a simple model, but you can easily augment that model with many more variables. But I think we have boiled it down to the absolute minimum that you need. So there's GDP growth as the macro variable. Then there's changes in bank capital, and then there are financial conditions. So we have three state variables in this economy: GDP growth, bank capital, that's the leverage variable in some sense, and then financial conditions. So the financial conditions in particular are calibrated. So all of this we're doing for the US, but of course you could do the same thing for Europe or any other jurisdiction around the world. So FCIs are calibrated basically to the CCAR 2020 scenarios. So this is the CCAR 2020, which was released just before the pandemic. So in some sense, the pandemic is like an out of sample test of the model. And then the key state variable for the banks is pre-tax net income. Okay, so this is the net income, so income net of interest payments, but pre-tax. And so this is the closest thing of what is used in the CCAR stress test itself in order to look at capital adequacy. And this PTNI is normalized by risk-weighted assets. So this is kind of like a capital ratio, so the inverse of a leverage ratio. And so PTNI is PPNR minus net losses. So basically, the difference between a true bank capital ratio, so the tier one equity ratio, and the PTNI ratio is taxes and capital distributions. And I'm going to talk about that quite a bit. So the reason that we're using PTNI is that it is a very stationary variable. So you see that in blue, you see that PTNI is very well behaved. So this is PTNI over risk-weighted assets. It's the inverse of leverage. You see it's extremely well behaved. While tier one capital is very non-stationary. And the reason, of course, is that during the sample period, regulatory changes meant that the capital ratio went from about 8% to about 14% in the sample period for this metric of capital. And so this is difficult to work with econometrically. So we use the PTNI, but of course, once you accumulate the PTNI, you get back capital. And so the historical CCAR assumption is one where a GDP growth is sort of stationary, and then there is a very bad scenario for 2020. And in fact, this very bad scenario corresponds pretty closely to what happened during the pandemic. So all of the data is as of 2019 Q4. The actual 2020 CCAR stress test was published in February, just before the pandemic hit. So the FCI is basically consisting of the corporate spread, the VIX, housing prices, Dow Jones, so equity market returns, mortgage spreads, commercial real estate, and term spread. So this gives the FCI, and the FCI is a very typical evolution. Here we compare it, for example, to the Chicago Fed FCI, and the CCAR gives us a scenario for all of these variables, right? So in the CCAR scenario, which we are basically trying to model here, financial conditions are tightening in 2020, and that's indeed something we saw in the pandemic. Of course, in the pandemic, financial conditions eased much more quickly than is assumed here in this scenario. So this scenario, in some sense, is more adverse than what we saw in 2020. The key observation is, of course, that GDP growth and financial conditions are tightly correlated, and that is particularly true when downside risks are realizing, right? And so this is what is giving rise to this conditionally skewed distribution of GDP that the vulnerable growth or growth at risk literature has documented. So we are going to specify an empirical model with data from 2000 Q1 to 2019 Q4, so 80 data points. And we are gonna look at a nonlinear system, and it's not going to be just a vector autoregression, it's going to be a whole conditional densities that are interrelated. So I'm going to explain to you in just a moment how we do this. And we look at causal identification. So we are using the instrumental variable approach of Gabex and Keuchen together with quantile regressions and those macro variables. So it's a dynamic system. YT is GDP, delta CT is the PTNI, FCI is the financial conditions index, and CT is the level of capital. As you know, accumulating CT gives back, accumulating delta CT gives back CT, but the CT also has the changes in the payouts in there. So there's sort of like a wedge in between. I will come back to that in a moment. And then we use a triangular identification. So GDP depends on its own lag and the lags of FCI and delta CT and CT, whereas delta CT, so this is the PTNI, depends on shocks to GDP, as well as the lags of the other variables. And then financial conditions at T+1 depend on shocks to GDP and PTNI, as well as the lag variables. So this is a classic triangular identification, and we're not going to use OLS regressions. We'll use quantile regressions to get the whole densities, conditional densities. Because it's triangular, we can solve for the conditional densities in a recursive way. So, you know, like are consistent with that kind of ordering. So you can see that there is the Granger causality, which evolves exactly in the way in which we are assuming. So GDP is the most exogenous variable. We cannot reject Granger causality by the two others, by FCI and delta capital. FCI is the most endogenous variable. We can reject that it is not Granger caused by the two others. Of course, we cannot reject that delta capital is Granger caused by GDP, but we can reject that it is Granger caused by the FCI. So this does look like a triangular system. Now, so it's a recursive quantile regression model. So we're not going to use OLS regressions, we'll use quantile regressions, and so we'll get the whole conditional distribution. And now we introduce this key other variable, which is C tilde. So C tilde is the cumulated PTNI ratio. So that would have been the capital level if payouts had not occurred. But of course, we are also controlling for the level of the capital ratio, CT, so that we get the changes in the payout into the system. And now the key next step is to get instrumental variables. So basically, in the system, there's endogeneity between financial conditions and regulatory capital. And so we are using instrumentation via granular instruments based on Gabex and Keuchen. So what we do, we use the cross-section of banks. So we have about 30 banks in the cross-section. These are the largest banks that are subject to CCAR tests. And we compute granular PTNI over risk-weighted assets and granular Tier 1 capital over risk-weighted assets. We're also instrumenting the FCI with banks' granular EDF, expected default rates, granular CAPM, cost of capital, as well as monetary policy shocks from CHISLAC and SHRIMF. Now, what are granular instruments? So assume you have a cross-section, say, of this PTNY variable. So first step, you run a parallel regression on fixed effects and time effects. And you take the residual of that, and then you extract the common components. And here you have to use a test for how many common components are significant. And then you take the residuals relative to those common components. So that is the idiosyncratic component to shocks to bank capital. And then basically the logic of Gabex and Keuchen is that these types of variables have fat tails in the cross-section, okay? They have a fat tail distribution in the cross-section, so that idiosyncratic shocks to the largest institutions are not averaging out. So then you cut off the largest institutions. So this is for the US here. So, you know, our cutoff uses the 4 largest institutions: Citibank, JP Morgan, Bank of America, and Wells Fargo. Those are the large institutions, and you evaluate the shocks, the idiosyncratic shocks to the largest institutions. And you use those as instruments. And so the cross-sectional and time series orthogonalization of the shocks via the panel regression and the PCA means that the exclusion restriction for a valid instrument is satisfied. And the averaging of the largest idiosyncratic shocks because of the fat tail in the cross-section means that the relevance condition for idiosyncratic shocks is satisfied. So these are valid instruments. So we're instrumenting delta CT, which is the PTNI, and we're instrumenting CT, which is the capital ratio, and we're instrumenting FCIs. All of these are tested, so these are valid instruments in the statistical sense and in the economic sense. And so the key of the paper now is to evaluate the macrofinancial feedback loop. So this is the contribution now of the paper. So the direct effect is defined as the real financial impact from GDP or from FCI to the banks. That's the standard stress test. So in standard stress tests, you take a macro scenario, you hit the banks, and then you ask how much capital do they lose. But of course, there's a feedback, because once the banks are losing capital, that has an impact on credit supply and an impact back into financial conditions and growth. And so and of course, in the triangular system that we identified so far, we do have the full feedback in a dynamic sense. It's just a triangular identification, but there's the full feedback in between bank capital, macro activity, and financial conditions. And so now we also compute a counterfactual model, a restricted model, where the feedback effect is shut off, okay? So this is basically the model. So this is our dynamic system where the impact of bank capital, PTNI, and the bank capital ratio onto GDP and FCIs is set to a constant, the sample average, in sample average. So then you get back to the micro-prudential approach. So the micro-prudential approach is exactly this. It's asking, what is happening to bank capital when there's a given scenario for YT, for GDP growth and financial conditions. And so this is a restricted system without the feedback effects. And so now we can estimate all the system and we can compute the counterfactual without the macrofinancial feedback. So first of all, we don't do OLS regressions, we do quantile regressions, and we fit kernel densities to get these distributions. So this is the conditional distribution of GDP alongside the CCAR scenario. So you see the CCAR scenario is assuming that from 2020, from February 2020 onwards, GDP growth is going down by approximately 10% over the next year to year and a half, and then recovers gradually. But of course, we can put a conditional distribution around that. And we are finding what we also documented in another work, which is that there's multimodality in the conditional GDP distribution. So you can end up in very bad places, but in the recovery, there's actually multimodality in the good sense. We do, of course, test our model out of samples. So these are the probability integral transforms. And you can see that across the whole distribution, we're doing extremely well in terms of fitting the data. These are in sample. These are PITs in sample, but we're fitting the conditional distributions extremely well. As you can see, we're always within these standard error bands. So these are, kind of like back tests, quantile by quantile. You can think about that. So if the actual versus the conditional is on the 45-degree line, you're doing well. And the standard error bands are around that. And so we're doing well for GDP, for capital, for delta capital, and for FCI for all 4 variables. So our simple framework replicates the aggregate path of bank capital over a 3-year horizon. And so this is the next picture. So this is the fan chart under the CCAR scenario. We start off with 14% bank capital. Remember that was in the opening chart. I showed you that bank capital had gone up to 14. And we can see that under the CCAR scenario, that is depleting by about 3 percentage points. And that is exactly the magnitude of a decline in the average CCARs between 2013 and 2020. So the magnitude of the decline that we estimate endogenously in our dynamic system corresponds to the magnitude of the decline that is assumed in CCAR tests using much more complicated models. And of course, because we use quantile regressions, we don't just have the median decline, we have a whole distribution around that. So you can see that things can get a lot worse. If you look at the 5th percentile here, for example, you have a loss down to 6%, so an 8 percentage point loss in the worst cases. And now again, the key contribution of the paper is to now ask, what are the losses in terms of GDP and capital losses with and without the macrofinancial feedback, okay? And so here we are looking at the counterfactual when the macrofinancial feedback is offset. And so here are the pictures. And so you can see basically here, these are the risk-weighted assets. So that's the capital path at the median and at the 5th percentile, with and without the feedback. So the direct effect is in purple and the feedback effect is in red. And you can see that the feedback effect is amplifying. And this amplification is particularly important when you're looking at worst case outcomes, so at the 5th percentile. But even at the median, there's quite a bit of feedback. So this is to say that by doing only microprudential stress testing, so by conditioning the stress test in only one direction, you have a macro scenario and a financial condition scenario, and you ask how bad is that for bank capital, and not taking into account that the decline in bank capital feeds back into GDP and FCIs, that is underestimating the severity of downside risks, right? Downside risk is worse once you take the macrofinancial feedback into account. So that is a major result of the paper. Macrofinancial feedback makes, in stress test scenarios, makes losses much bigger. It's kind of obvious, but to our knowledge, nobody has ever shown this. And so the magnitude is, that a capital surcharge of 1.5 percentage points for the median or 3.4 percentage points for the 5th percentile. So the wedge here is about 3.4 percentage points in the 5th percentile and 1.5 percentage point in the median. So relative to the overall losses, this is large. And you can also see the macrofinancial feedback effect for GDP. Here, actually, the difference between the median and the 5th percentile is not as pronounced. So basically, the impact of the loss in capital on GDP of the macrofinancial feedback is pretty bad in both the median and the 5th percentile of the GDP distribution, and it's quantitatively very large, as you can see. Several 1.5 percentage point for the median and more for the 5th percentile. Now, now comes the policy. So now we go to the last section of the paper in some sense, which is, what does that mean for capital surcharges? And so here we define something new, which is called the growth at risk gap. Okay, so this is defined in the lower formula there at the bottom of the slide. So the growth at risk gap is the difference between the conditional and the unconditional quantile. Okay, so this is trying to isolate the difference between structural and cyclical vulnerabilities. So this is basically downside risk conditional on FCI and PTNI, bank capital, conditional on the current state relative to the unconditional distribution. So let's take a look of how that looks. So here we show you the growth at risk gap for the 5th percentile of growth at risk and the 50th percentile. And of course, the gap is going to be larger for the 5th percentile because this growth at risk distribution is very negatively skewed, as I explained at the beginning. But the cyclical pattern is fairly similar. So depending on how risk averse you are, as a regulator, you would pick either the 5th percentile or the 50th percentile for calibration reasons. If you follow this growth at risk gap, that can be used to basically turn the countercyclical capital buffer on and off. And so the logic here would be that when the metric is green, then you're in the boom. So you would accumulate capital. And when the gap metric is red, that's in the bust, you would release the capital. And now comes one key comparison. I told you at the very beginning that there is a methodology that is used by many, which is based on the credit to GDP gap. And so the left chart shows you the credit to GDP gap, and it is an extremely persistent variable, right? So many times people say that, well, the financial cycle moves at much lower frequencies than the business cycle. And the reason is shown here in the left chart, which shows you the credit to GDP gap, which is Hodrick-Prescott filtered for the US. And you can see you would have turned on the countercyclical capital buffer between 2002 and the 2008 crisis. You would have turned it off. and you wouldn't have turned it on, and you might not turn it on for 2 decades or so. So it's a very low frequency thing. Ours is much more high frequency. As a matter of fact, ours is more high frequency than the business cycle, because our financial cycle is one that is based not on quantities like credit to GDP, but on financial conditions, which are kind of like asset prices or risk premium. So what you would see here is that you would turn on the credit to GDP, the countercyclical capital buffer before the 2008 crisis, then you release the buffer in the 2008 crisis. Then you would accumulate again, but in the European debt crisis, which also spilled into the US, of course, you would release it. Then you would accumulate again, but release it. Remember, in 2015, there was a huge tightening of financial conditions when China contracted and oil prices, collapsed. And so you would have released it, but very shortly only, and then you would accumulate again. So it's a much higher frequency. It's higher frequency than the business cycle because it's linked to financial conditions and the tightening of financial conditions. And so the growth at risk gap just summarizes the different vulnerabilities in a consistent metric that is measured in GDP terms. So this has very desirable properties because losses are directly measured in terms of GDP losses, which is our typical welfare criteria. And so the credit to GDP gap is not risk-based, while our growth at risk gap is risk-based, right? It's exactly doing what we would like to do from a welfare point of view. So now let me go from the growth at risk gap to the CCYB. So conceptually, vulnerabilities include the macrofinancial feedback, recursively estimated with instrumented quanta regressions. This provides a countercyclical state-dependent and risk-based capital surcharge. So this capital surcharge in particular is defined as the additional bank capital that is needed to offset the macrofinancial feedback, okay? So now we calculate in order to offset the feedback that we measured earlier, right? Our triangular system could measure the feedback. But if you have more bank capital, then you can sort of like offset the feedback effect. And so we calibrate the CCYB exactly to an amount where you're offsetting the macrofinancial feedback. So it depends on the state of the economy as well as the level of capital in the banking system, of course. It's only activated when the growth at risk gap is positive, and it's released when the growth at risk gap is negative. And there's a menu of policy preferences, policy options, depending on risk preferences of the policymaker. So how much risk aversion the policymaker has. So this is how this looks like. So here's the growth at risk gap at the 5th percentile. So here we are a fairly risk averse regulator. And we use, we show you the calibrated CCYB, calibrated either for the median, which is the thick black line, or the 5th percentile or the 95th percentile. So for the median, it's on average about 1.5% to 2%, which is roughly the BIS guidance. But if you are very risk averse, you would actually go up to 5% or even higher sometimes in terms of your CCYB. While if you're very risk tolerant, you would never go above 1% of CCYB. So the magnitude of the buffer directly maps into the degree of risk aversion that you have as a policymaker or as a country in some sense. And so you can see that the CCYB would be turned on and turned off depending on where you are in your growth at risk gap. And when you do this, basically, then you can show that the counter-cyclical capital buffer is offsetting the macrofinancial feedback. It's calibrated to do exactly that. So the main takeaways are that we propose a parsimonious, stylized, 3-variable macrofinancial model with rich policy implications and realistic results Of course, you could augment that and have many more variables, but the basic economic logic is what is the most important here. Using the 2020 CCAR results for the US, but of course you could do that for many other countries, our proposed vulnerability metric, the growth at risk gap, informs the setting of a countercyclical capital buffer that offsets the macrofinancial feedback through the business cycle. The capital surcharge pre-GFC, pre-global financial crisis, should have been on average about 1.9 percentage points. And for the upper bound, which is the upper bound of the Basel III recommendation of the CCYB, but it should have been higher, about 4.6% for the fifth percentile. And the capital surcharge on the median in the post-financial crisis would be between 1.4 and 3.2%, depending on where you are in the cycle. Now, for stress testing, there's an important takeaway here, which is that traditional stress tests overlook macrofinancial feedbacks, right? They only go in one direction. They only go from macro and finance to banks, and they don't model explicitly the feedback from the banks back into macro and finance. So our methodology can easily augment the current stress testing machinery to include the calculation of the macrofinancial feedback and the capital surcharge. So you could have this auxiliary VR, stress test models are all kind of like recursive systems. So you have this auxiliary variable that models the feedback from bank capital into the macro variables. And so you can do exactly what we are doing within the setting of a supervisory stress test.